Decentralized finance, DeFi, refers to a fast-growing sector within the blockchain space that uses decentralized networks and protocols to transform traditional financial systems. Unlike traditional finance, which relies on intermediaries such as banks, DeFi eliminates the need for these middlemen by leveraging blockchain technology. With DeFi, financial transactions, services, and products are conducted directly between users, peer-to-peer, using smart contracts, primarily on Ethereum and other blockchain platforms. Key characteristics of DeFi applications. DeFi applications operate on decentralized networks, primarily blockchain platforms like Ethereum. This removes the need for a central authority or intermediary. Users maintain control of their assets and conduct transactions using smart contracts, self-executing code that automatically enforces terms and agreements, permissionless and trustless. Anyone with an internet connection and a cryptocurrency wallet can access DeFi applications without needing approval or verification from a centralized institution. Trust is not placed in third-party intermediaries, but in the security and transparency of the blockchain network and smart contracts. DeFi applications often interact seamlessly with each other, creating a cohesive ecosystem where various services like lending, borrowing, trading, and yield farming can interconnect. This interoperability allows users to benefit from multiple services without needing to leave the DeFi space. Transparency and immutability. All transactions within DeFi applications are publicly recorded on a blockchain, ensuring transparency. Since blockchain records are immutable, data cannot be altered, ensuring the integrity of transactions. Popular DeFi applications. Decentralized exchanges, DEX, like Uniswap, SushiSwap, and PancakeSwap, are platforms where users can trade cryptocurrencies directly with one another without the need for a centralized exchange. They operate using automated market makers, AMMs, and liquidity pools, allowing for continuous trading of assets without intermediaries. One of the most popular DEX on Ethereum, Uniswap, allows users to trade ERC20 tokens directly. It uses a liquidity pool model, where users contribute assets to pools, earning fees from trades. A DEX on Binance Smart Chain, BSC, offering similar features as Uniswap, but with lower transaction costs and faster settlement times due to the BSC's more efficient architecture. Lending and borrowing platforms. DeFi applications like Aave, Compound, and MakerDAO allow users to lend their assets or borrow against them without intermediaries. These platforms use smart contracts to automate lending and borrowing, and users can earn interest or access liquidity by providing collateral. Aave offers a wide range of lending and borrowing options with dynamic interest rates. It introduced the concept of flash loans, enabling users to borrow without collateral as long as the loan is repaid within the same transaction. Compound enables users to lend their crypto assets and earn interest or borrow against their holdings. It uses liquidity pools for lending and offers variable interest rates based on supply and demand dynamics. Stablecoins are cryptocurrencies pegged to the value of stable assets, such as fiat currencies, USD, EUR, or commodities, gold. These are used to mitigate the volatility common in the crypto market, and DeFi applications often integrate stablecoins to provide more stability in their services. A decentralized stablecoin, created by MakerDAO, DAI, is pegged to the US dollar and maintained through a system of collateralized debt positions, CDPs, on the Ethereum blockchain. These are centralized stablecoins, backed by reserves held by their issuers. Though they are not fully decentralized, they are widely used in DeFi applications for trading, lending, and other services due to their price stability. Yield farming and liquidity mining. Yield farming refers to the process of earning rewards by providing liquidity to DeFi platforms. Users can lock up their crypto assets in liquidity pools, which are used for various financial services, such as lending and trading. In return, they earn interest or governance tokens. A DeFi protocol that automates the process of yield farming, allowing users to optimize their returns across different DeFi platforms. Known for its liquidity mining rewards, SushiSwap incentivizes users to provide liquidity to its pools by rewarding them with its native SUSHI token, which can be used for governance or additional staking. Insurance protocols. Since DeFi is inherently risky due to the use of smart contracts and the possibility of hacks or bugs, decentralized insurance platforms have emerged to mitigate these risks. These protocols allow users to insure their assets and DeFi investments against smart contract failure or other issues. Nexus Mutual is a decentralized insurance protocol that offers coverage for smart contract risks. Users can buy coverage for a certain DeFi protocol, and in case of a failure, a payout is made to the insured. This platform allows users to buy and sell insurance against risks in the DeFi ecosystem, with payouts determined by decentralized governance. Benefits of DeFi applications: access to financial services for the unbanked. One of the most significant advantages of DeFi is the potential to provide financial services to the unbanked or underbanked populations worldwide. Since all you need is an internet connection and a cryptocurrency wallet, people who do not have access to traditional banking infrastructure can participate in global finance. By eliminating intermediaries, DeFi applications often offer lower transaction fees and better rates for lending, borrowing, and trading. Traditional financial services come with fees for third parties like brokers, clearinghouses, or bankers, which are absent in DeFi. Ownership and control. In DeFi, users have complete ownership and control over their assets. In traditional banking systems, banks or financial institutions control user funds, and access can be restricted. In DeFi applications are powered by smart contracts, which automate processes such as loan issuance, repayments, and interest distribution. This automation reduces the possibility of human error, speeds up transactions, and eliminates bureaucratic delays. Transparency and security. Transactions in DeFi are transparent and visible to anyone with access to the blockchain. Additionally, blockchain technology provides a level of security that is difficult to achieve in traditional finance. Every transaction is cryptographically secured, and the use of decentralized networks reduces the likelihood of single points of failure. Risks and challenges of DeFi applications. Smart contract vulnerabilities. Since DeFi relies heavily on smart contracts, any bugs or vulnerabilities in the contract code can result in significant financial losses. Hacks and exploits have occurred in the past, where attackers were able to drain funds from liquidity pools or manipulate the system. Regulatory uncertainty. The DeFi space is still in its early stages and operates outside traditional regulatory frameworks. This lack of regulation presents risks for users, especially in the case of fraud, security breaches, or protocol failures. Regulatory bodies around the world are working to develop frameworks, but the decentralized nature of DeFi poses challenges for enforcement. Liquidity risks. Many DeFi protocols rely on liquidity pools contributed by users. If there is insufficient liquidity, the entire system can become unstable, leading to issues with asset withdrawals, loan liquidations, or token swaps. Low liquidity can also exacerbate price slippage, making trades less efficient. Volatility of cryptocurrencies. While stablecoins help to mitigate some volatility, most assets in DeFi are still cryptocurrencies, which are notoriously volatile. Sudden price swings can lead to the liquidation of collateralized loans, impermanent loss in liquidity pools, or drastic changes in yields. User experience and complexity. DeFi is still a complex field, often requiring a high degree of technical knowledge and understanding of how blockchain, smart contracts, and cryptocurrencies work. The user interfaces of many DeFi applications are still not as intuitive or user-friendly as traditional financial platforms, which can deter mainstream adoption. The future of DeFi. Scalability solutions. Ethereum's high gas fees and transaction congestion have been a major bottleneck for DeFi. Layer 2 solutions like Optimism and Arbitrum are being developed to improve scalability, making DeFi transactions faster and more affordable. Participation. As DeFi matures, more institutional players are expected to enter the space. Institutional participation could bring more liquidity and stability, though it may also prompt the need for more regulatory oversight. Regulatory developments. Governments and regulatory bodies are closely watching DeFi, and future regulations could significantly impact the sector. While some fear that regulations may stifle innovation, others believe that clearer regulatory frameworks could bring more legitimacy and safety to DeFi. If you enjoyed this video and want to stay updated on the latest trends in crypto and DeFi, make sure to like this video, subscribe to the channel, and hit the notification bell so you don't miss any future updates. Thanks for watching, and we'll see you in the next one.